Why regulation never moved fast enough. They wrote the rules after the damage was done. They reacted once the system was already shaking. And every time they arrived too late. To understand why regulation struggled to keep pace with European banking, we need to look at how change actually happened. Because the problem was not a lack of intelligence or effort. It was timing. Markets evolved continuously, while rules moved in steps. For decades, regulation was designed for stability, not speed. Banks operated within clear national boundaries. Supervisors knew their institutions. Risks were familiar, and change was gradual. Laws could afford to move slowly, because the system did too. But Europe accelerated. Financial integration reshaped banking faster than legal frameworks could adapt. New products emerged. Cross-border structures multiplied. Balance sheets expanded beyond the scope of existing rules. What had once been exceptional became routine. Regulation tried to follow. Committees studied the changes. Reports were written. Reforms were debated across multiple governments. Each step required consensus, translation, and implementation. By the time new rules arrived, the market had already moved on. This created a dangerous gap. Banks operated in the present. Regulation lived in the past. Supervision relied on data that reflected yesterday's risks, not today's exposures. Innovation outpaced oversight, not through deception, but through momentum, and incentives mattered. Banks were rewarded for growth, for efficiency, for return on equity. Regulation was rewarded for caution, precision, and political acceptance. These priorities rarely aligned under pressure. At first, the mismatch felt manageable. Markets were calm. Profits were strong. Failures were rare. Slow regulation looked prudent, even wise. Few questioned whether the rules still matched reality. But beneath the surface, complexity was building. Products became harder to classify. Risks moved across borders instantly. Responsibility blurred between national authorities. Each regulator saw a part of the picture, but no one saw it all. Europe had a regulatory system designed for a world that no longer existed. And the longer it took to adapt, the more fragile the system became. Because when rules lag behind reality, stability depends on assumptions. And assumptions do not hold under stress. The lag was not accidental. It was structural. European regulation moved through layers of agreement. National interests had to align. Legal systems had to translate intent into law. Supervisors had to apply rules consistently across very different banking cultures. Every step slowed the process. Meanwhile, markets did not wait. Banks adapted their structures faster than rules could define them. They created hybrid instruments that blurred categories. They shifted activities into areas with lighter oversight. What could not be prohibited, yet could still be exploited. This was not illegal. It was inevitable. Regulation was reactive by design. It responded to what already existed. But modern banking thrived on anticipation. Institutions moved toward opportunities long before frameworks could respond. Supervisors felt the pressure. They relied on reporting systems that captured risks with delay. Data arrived quarterly, sometimes later. By the time patterns emerged, positions had already changed. Intervention was always one step behind. And complexity worked as camouflage. As banks grew larger and more interconnected, understanding them required resources regulators often lacked. Models became opaque. Internal risk assessments replaced external judgment. Oversight shifted from direct control to trust in internal systems. Trust became a substitute for speed. But trust assumes alignment. And alignment weakens when incentives diverge. During expansion, slow regulation appeared harmless. During stress, it became dangerous. Rules designed for yesterday's balance sheets failed to constrain today's exposures. What was once manageable turned systemic before anyone could respond. Political realities added friction. Stricter rules risked slowing growth. Tighter oversight risked pushing activity elsewhere. Every reform carried trade-offs. And in a competitive global environment, hesitation felt safer than decisive action. Until it wasn't. When cracks appeared, regulation rushed to catch up. Emergency measures replaced careful planning. Temporary solutions filled permanent gaps. Speed arrived only after damage was visible. Europe learned a hard truth. Regulation that moves too slowly does not prevent crises. It explains them after the fact. And by the time the rules finally arrived, the system they targeted had already changed again. When the system finally broke, regulation faced its moment of reckoning. Rules that once seemed thorough proved insufficient. Capital buffers were too thin. Liquidity requirements were incomplete. Cross-border exposures had been underestimated. The frameworks in place could describe the system, but they could not contain it. Emergency replaced process. Decisions were made overnight that once took years. Guarantees were issued. Restrictions were imposed. Authorities acted first, then justified their actions later. Speed mattered more than precision, because hesitation now carried immediate cost. This exposed a painful contradiction. Regulation had been slow when time was available, and fast only when options were limited. The very caution meant to protect stability ended up amplifying shock when reality moved faster than rules. Coordination became unavoidable. National supervisors were forced into constant communication. Information sharing accelerated. Authorities shifted upward, not out of design, but necessity. Fragmentation had become a liability the system could no longer afford. Yet even in crisis, limits remained. Legal mandates constrained action. Political boundaries shaped decisions. Responsibility was still divided. Even as risk was shared, regulation could respond, but not fully control outcomes. Banks adapted again. They learned to operate under uncertainty, to anticipate future rules before they were written, to restructure balance sheets ahead of enforcement. The cycle continued, but with higher stakes and less tolerance for error. What emerged was not a victory for regulation. It was an acknowledgement of constraint. Rules could guide behavior, but not eliminate risk. Oversight could reduce excess, but not predict every failure. The belief that regulation alone could guarantee stability quietly faded. Europe began to rethink its approach. Instead of chasing every innovation, the focus shifted to resilience, to buffers that absorbed mistakes, to principles that applied even as structures changed. Regulation aimed not to be faster than markets, but strong enough to withstand them. This was a shift in philosophy, from control to containment, from prediction to preparation, because the crisis made one thing clear. In a system that evolves constantly, regulation will always arrive late. What matters is whether it arrives strong enough to matter. Out of failure came adjustment. European regulation did not suddenly become faster. It became heavier. Thicker buffers replaced precise predictions. Liquidity rules assumed stress, not calm. Capital was designed to absorb shocks regulators knew they would never see coming. The system learned to live with delay. Instead of trying to anticipate every risk, authorities focused on limiting damage when assumptions failed. Banks were required to hold more, not because models demanded it, but because uncertainty did. This changed behavior. Growth slowed. Returns fell. Complexity became less attractive, not because it was banned, but because it became expensive to maintain. Regulation reshaped incentives rather than chasing structures. Coordination deepened. Supervision moved closer to where risk actually lived. Information flowed faster. Authority followed exposure instead of geography. Europe accepted that fragmented oversight could not govern integrated finance. But the core tension remained. Markets will always move faster than rules. Innovation will always test boundaries. Regulation will always arrive after reality has shifted. That is not a failure of effort. It is a feature of complexity. What matters is preparedness. Rules that assume calm will fail under pressure. Systems built for efficiency will strain under stress. Stability does not come from speed, but from margin, from space to absorb mistakes. European banking carries that lesson today. Every capital buffer reflects past delay. Every liquidity rule remembers a moment when timing mattered. Regulation no longer promises prevention. It promises survival. Because in a system this large, this connected, and this fast, perfection is impossible. Resilience is not. Subscribe to join the journey. Why?